Have you ever heard of the lipstick effect?
The economic theory, yeah.
Exactly. It's this classic idea that when the economy gets a little shaky, people can't afford the big luxuries, a new car, a vacation.
Right.
But they still have this psychological need to treat themselves. So instead of the trip to Maui, they buy a premium lipstick, a small, affordable luxury.
Yeah, Leonard Lauder from Estee Lauder coined it, I think, back in the early 2000s.
Well, looking at the data we have today, I think we need a new name for 2026. I'm calling it the smoked paprika effect.
The smoked paprika effect. I like that. It's got a nice ring to it.
It's the exact same psychology. It's just moved from the vanity mirror to the kitchen pantry.
Mm.
You might be skipping that $80 steak dinner because, inflation is still a thing.
Yeah.
But you are absolutely willing to drop maybe $10 on some gourmet Himalayan pink salt to make your Tuesday night eggs feel like an event.
And that specific shift in behavior, that whole drive to make the home meal countertop worthy, is actually the entire story we're covering today.
We are doing a deep dive into McCormick Company. And before you tune out thinking, great, a deep dive on black pepper, you have to stay with us. Because this is not just about spices.
Not at all.
This is a huge bellwether. If you want to understand the global economy, if you want to understand trade wars and how inflation is really hitting families, you don't look at a tech company. You look at McCormick.
It's a perfect microcosm of the whole consumer landscape. So they released their Q4 2025 earnings report on January 22nd, 2026. And the market's immediate reaction was, well, let's just say it was grumpy.
Grumpy is being polite. The stock took a nosedive. It dropped, about 8% right out of the gate?
Which sets up the central mystery here. Because when you look at the actual behavior, people are buying more hot sauce. They're buying more cinnamon.
Yeah.
Revenue was actually up.
Yeah.
So why is Wall Street so mad?
That's the question. So let's dig in. On the surface, the headline numbers look pretty good.
They did.
They brought in $1.85 billion in revenue for the quarter. That actually beat expectations.
A solid revenue beat. But, in the world of quarterly earnings, you live and die by the bottom line. And their earnings per share, the EPS, came in at 86 cents.
And the expectation was?
87 cents.
Wait, so they missed by a penny?
A single solitary penny.
And the stock drops 8% off of that. I mean, that feels incredibly disproportionate.
It feels harsh. But it just shows how high the stakes are. The market is priced for perfection. Any tiny stumble gets punished. But here's the twist. If you actually listen to the earnings call, and I did, so you don't have to, the CEO, Brendan Foley, and his team, they were not sounding apologetic. They were practically beaming.
Why? If my stock just cratered, I would not be beaming.
Because they achieved something that has become incredibly rare in the consumer packaged goods world. I mean, it's really the holy grail of CPG.
Oh, shiz.
Volume-led organic growth.
Oh, yeah, unpack that for us, because we hear growth thrown around all the time. Why is volume-led the magic phrase?
So think about the last 3 years. We had all this inflation, and most food companies grew their revenue with a really simple trick: pricing. They just charged more.
Right.
They actually sold fewer boxes of cereal, fewer bags of chips, but they just jacked up the prices 20, 30%. So the revenue number looked good, but they were actually losing customers.
The shrinkflation era, or just straight up price hiking.
Exactly.
Yeah.
And that's pricing-led growth. It's fragile. Eventually, the consumer just snaps. What McCormick did this quarter is the total opposite. They grew their consumer volume for the 7th consecutive quarter.
So they are not just making more money because things are more expensive. They are physically moving more bottles of mustard and jars of oregano off the actual shelves.
Precisely. And that's the hardest thing to do in this economy. In fact, in the U.S., their volume is outpacing the broader total edible category.
Wait, total edible? Is that like a real industry term?
It is. It basically tracks all the food sold in retail.
Hmm.
So what it means is Americans are buying McCormick spices at a faster rate than they're buying, food in general.
That is a wild statistic. And that brings us right back to our smoked paprika effect. So why is this happening? Are we all just becoming master chefs overnight?
It's the economy, but it's nuanced. The management team talked a lot about a consumer they called the learner profile.
The learner.
Yeah, it's younger or newer cooks, often in low to middle income households. I mean, these are people under serious financial pressure. And the data shows they're shopping more often, but buying fewer things each time.
I feel seen. You go in for 3 specific things because you are terrified of that $300 big shop. You're just managing cash flow week to week.
Exactly. It's budget management. And they're doing something called stretching.
Making food last longer.
Right. It's the big potted chili that feeds a family for 3 days.
Hmm?
It's buying a cheaper cut of meat and slow cooking it. But here's the catch, and this is where McCormick wins. If you are eating leftovers for 3 days, or just rice and beans to save money, it gets boring, fast.
It gets miserable. Palate fatigue is a real thing.
Unless you spice it up, literally. Flavor is the absolute cheapest way to vary a diet. You can have Mexican chicken on Tuesday and then turn those leftovers into like a savory stir-fry on Wednesday just by changing the seasoning.
So it's making the budget cuts bearable. But I did notice in the report they're not just selling the basics. They specifically called out their gourmet collections and holiday finishing sugars. That doesn't exactly scream survival food.
And that's the lipstick part of the effect again. Even if you're feeling broke, you want to feel like you're living well. McCormick actually revamped their gourmet line with what they called countertop-worthy packaging.
Countertop-worthy, that is such a specific and brilliant phrase.
It's brilliant psychology. They know that in the age of, open concept kitchens and Instagram, the spice bottle itself is a prop. You want that bottle on your counter to signal, I have taste, I know what I'm doing.
It's affordable status signaling. For $12, you get to feel like you're on the Food Network.
And this isn't just an American thing, right? I saw a note about air fryer seasonings in Europe.
Yes, in the EMEA region, Europe, Middle East, Africa. And this is a great example of them being agile. Everyone bought an air fryer. It's the appliance of the decade. But if you've ever used one, you know it can make food kind of bland if you don't season it right.
Oh, yeah. Unseasoned air-fried broccoli is just sad.
It is. So McCormick saw the gadget trend, and boom, they launched product lines specifically for it. They saw the hardware shift, and they updated the software, the flavor, to match it.
That's just smart. But there is one more trend driving this that we have to talk about, the health and wellness angle.
This is huge. They're seeing a big shift away from what they call the high-carb, high-sugar alcohol basket.
Ah, the fun basket.
The fun basket is out. The high-protein, better-for-you basket is in. We're seeing this massive cultural shift to protein-heavy diets. Part of that is the GLP-1 drugs, for sure, but it's also just a bigger trend.
And the problem with a high-protein diet is boiled chicken breast is just awful.
It's flavorless cardboard.
So if you take away the fat and sugar, which are the traditional carriers of flavor, you have to replace it with something. Herbs, spices, seasonings. If you're eating healthy, you're almost forced to use more. That is a massive tailwind for them.
Okay, so the volume story is all good news. People are cooking, they're health conscious, they're stretching their dollars. But if everything is so great, why did the gross margin drop?
I'm looking here, down 120 basis points. For a company like this, that's a steep fall.
This is where the story gets messy. This is where the macroeconomics come crashing right into the kitchen. It's a mix of some commodity inflation, but the big, scary word in the report is tariffs.
Ah, tariffs. The word that keeps importers up at night.
McCormick sources from 80 different countries. They deal with 17,000 different ingredients. Vanilla from Madagascar, pepper from India. When trade policy shifts, they feel it instantly.
But I thought I saw they fixed this. There was a line about reducing their exposure.
They did, and it's actually really impressive. They cut their gross annualized tariff exposure from $140 million down to $70 million.
A 50% reduction. That's huge. It is. They shifted supply chains. They moved sourcing. They basically played a massive game of global logistics Tetris.
So what's the problem then?
The problem is time. We have to talk about inventory lag.
Okay, explain that to me like I'm 5.
Imagine you buy a shipload of vanilla beans in October. You pay the tariff on them right when they land. But you don't actually process, bottle, and sell that vanilla until, say, February. That cost just sits on your balance sheet until you sell the final product.
So the expense is trapped in the warehouse.
Exactly. Even though they fixed the long-term problem, that expensive inventory they bought months ago is still flowing through the system. And because of that lag, they expect a $50 million incremental cost hit in 2026.
So the bill for last year is coming due this year.
That's it. And that brings up the big question. Who pays that $50 million?
Usually it's me, the consumer.
Usually. But this time management used a very specific phrase, surgical pricing.
Surgical pricing, that sounds precise and a little ominous.
It's actually good for us. It means they're not doing a blanket price hike across the board. They know that learner consumer is stretched thin. If they just raise the price of basic black pepper by $1, you're just going to buy the store brand.
Right. Pepper is pepper. I'm not loyal if it's double the price.
So they're eating some of that cost. They're taking a hit on their margins to keep you as a customer. They'll only raise prices on, say, that special air fryer seasoning where they have more power.
Protecting market share over short-term profit.
That's the long game. But Wall Street hates it because it hits margins today.
Okay, so that's the consumer side. But there was another massive piece of news in this report, the acquisition.
Oh, yeah. The jalapeno in the room. McCormick de Mexico.
The whole tone of the call shifted when they got to this. It felt like a victory lap.
For good reason. For years, McCormick only owned 50% of this business. It was a joint venture. But as of January 2nd, 2026, they acquired a controlling interest. They basically bought the whole pie.
Does it actually change the business? Or is it just a financial move to make the books look bigger?
Oh, it completely changes the growth profile. This is expected to add 11 to 13% to their sales growth in 2026. Alone. That's massive.
But wait, isn't that just buying growth?
It is buying growth, but it's accretive, which is the key word. It means it immediately boosts their profit per share. And strategically, it's a huge bet on demographics. Mexican cuisine is the #1 flavor driver in the U.S., and it's growing everywhere.
Hot sauce, taco seasoning, salsas, you see it everywhere.
And by owning the brand and the supply chain outright, they control their own destiny in their biggest growth category. It's a smart move.
Okay, so that's the spicy side. But let's talk about the other half of McCormick that people forget about. Flavor solutions.
BDB side. Their hidden empire.
This is where they sell flavors to the other giant food companies, right? Like the dust on a bag of Doritos.
Exactly. They sell to PepsiCo, McDonald's, all the big players. And frankly, 2025 was a pretty rough year for this part of the business.
Why? If we're buying more spices, aren't people also buying more chips?
Not as much. The big CPG companies, the snack giants, they sold less volume last year. So if people buy fewer bags of chips, McCormick sells less seasoning dust. Simple as that.
So that division was a dead weight.
It was. But there was a really interesting silver lining here. They talked about winning huge contracts for reformulation.
Reformulation, what is that?
It's basically a science experiment. Think about all the pressure the big food companies are under. The government wants less sodium. Consumers want less sugar. Accountants want cheaper ingredients.
But if you take out salt and sugar, the food tastes awful. We've all had those sad, low-sodium snacks.
Unless you have a flavor wizard, that's McCormick. They work with these companies to reformulate their recipes to keep the taste the same while changing the chemistry underneath to meet those health or cost targets.
So when a snack bag says, new great taste, 20% less sodium, McCormick is the company that actually made that happen.
They're the flavor fixers. And that creates a moat, you know. Once McCormick is baked into your recipe, it's really hard and risky to fire them.
A very sticky business. I like that. Okay, let's hit the last pain point. We mentioned tariffs, but there was another cost that stood out. The dreaded ERP implementation.
Ah, yes. Enterprise Resource Planning. The 3 letters that make every CFO break out in a cold sweat.
They said this is going to be a drag on 2026 earnings. Why is upgrading software so expensive?
It's more than software. It's the company's entire digital nervous system. And they're doing what they call a refined execution plan, which is just corporate speak for we're ripping the Band-Aid off faster.
So instead of spreading the pain over 3 years, they're taking the hit now.
Yes. It reduces risk, but it plows all the costs, the consultants, the overtime right, into 2026.
It's the take your medicine approach.
It is. And this all leads us to the guidance for 2026, which is where all these threads come together.
Let's run the numbers. What are they promising?
Sales growth, 12 to 16%.
Which is huge, but we know that's mostly the Mexico deal.
Mostly Mexico, yes. Operating income, 15 to 19% growth, also very strong. Operationally, the machine is humming.
But, and there's always a but.
But earnings per share, the number Wall Street really cares about, is only projected to grow 2 to 5%.
Whoa, that is a massive gap. Operating income up almost 20%, but earnings are basically flat. Where did all the money go?
2 places. The taxman and the bankers.
Explain.
Their tax rate is jumping a lot, from about 21.5% up to 24%. That eats a huge chunk of profit. And then they had to borrow money to buy the Mexico business. Interest rates are still high, so those interest payments are draining cash from the bottom line.
So the business of actually selling spices is doing great, but the business of financing the company is really expensive right now.
That's the perfect summary. It's a transition year.
And transition years usually mean the stock price goes nowhere.
Often, yes. The market hates complexity. But if you zoom out, McCormick is proving something really important. They have pricing power and they have volume growth.
Right. You can do financial tricks for a few quarters, but you can't fake people picking your bottle of paprika off the shelf.
William doesn't lie.
Before we wrap, quick global check-in. China has been a trouble spot for everyone. What's happening there?
It's a gradual recovery, not a boom. Their retail business is strong. Again, people cooking at home. But food service, so Western restaurants in China, that's still soft.
And Europe.
Surprisingly resilient. Both pricing and volume are up. They're gaining market share in places like France and Poland. It seems the European consumer is behaving a lot like the American one.
So let's bring it all back. What's the big takeaway from our smoked paprika effect?
The takeaway is that McCormick is a really resilient company in a very volatile world. They're winning on the shelf. That's the hardest place to win. But 2026 is going to be messy. They have to digest this huge acquisition, pay the tariffs, and finish the tech upgrade.
It sounds like the story is, cooking at home is recession-proof, but shipping spices around the world is not inflation-proof.
That sums it up perfectly.
I want to leave everyone with one final thought I found in the report. Management briefly mentioned something called social commerce.
Yes, this is definitely a space to watch.
We all see the viral recipes on TikTok, right? The baked feta pasta, the cucumber salad. McCormick explicitly said that this is reshaping how people buy packaged goods.
And it raises a fascinating question. Right now, McCormick wins because they have the best spot on the shelf in aisle 4.
The wall of red caps, you literally can't miss it.
Exactly. Yeah. But in the future, does that shelf even matter? If you see an influencer making a dish and you can just click a button in the video to have the ingredients delivered.
The shelf becomes the algorithm.
Exactly. If McCormick can crack that code and become the default ingredient in the click-to-buy recipe, they shift from being a grocery brand to a media-driven one. And that's where you could see exponential growth.
That's fascinating. Less about fighting for shelf space at Kroger and more about fighting for screen time on TikTok.
Welcome to the future of food.
Well, that's all we have time for. My big takeaway is I need to go check my spice rack because I'm pretty sure my cumin expired during the Obama administration.
It almost certainly did. Please throw it out.
Thanks for listening to The Deep Dive. We'll catch you next time.